Hello and welcome to Buddha IAS. Dear students, today we'll be starting a very important reference book for UPSC, that is Economic Survey. Economic Survey is very important because more than 50% of the questions with respect to economy are coming from Economic Survey directly. Not only that, Economic Survey also contains valuable information with respect to agriculture and also environment. This is a brief about me. I have been teaching UPSC aspirants since 15 years and I have been reading economic survey since 2006. Having said that, let's get started. Today we'll discuss chapter number 1, State of Economy, Recovery Complete. So here the economic survey says that the recovery is over from the pandemic. It also illustrates very important factors saying that countries like Japan and Denmark, they have degraded coronavirus to flu virus. They have equated to flu virus. They are saying that it's not more than a flu virus. With respect to chapter number 1, the most important aspect here is here all the information given are new, de novo. They are not given in any book, any of the economy book, whether you read any material, that this information is not there. This is very important because complete information is provided, comprehensive coverage of the topics, whatever topic they have covered comprehensively, and it deals about Indian macroeconomy, especially in the third decade of the millennium, that is after 2020. To be specific, after the pandemic. And also it deals with world economy since February 2022. So there is a need of detailed analysis of this chapter. Among the chapters, there are 12 chapters. Among these, two chapters are very important. That is chapter number 1, which we will be discussing today, and also chapter number 2, for the same reason that all the information provided here is new. This information is not present in any book. With respect to the content, there is a flow in the content. There are 5 topics in this chapter. All these topics are in a flow. First, it starts with global economy battles through a unique set of challenges. Macroeconomic growth challenges in Indian economy. India's economic resilience and growth drivers. India's inclusive growth. Fifth one, Outlook 2023-24. Dear students, the chapter starts saying that the global economy has gone through unique set of challenges, one of its kind, those kind of challenges we never faced. Because of that, there are some macroeconomic and growth challenges for the Indian economy. But Indian economy is resilient and there are many growth drivers which make the economy grow faster than the world economy. At the same time, it says that our growth is not one-sided, it is inclusive. Sabka saath, sabka vikas. Having discussed all these things, there is an outlook for next year, that is 2023-24. Challenges. What are the challenges? With respect to challenges, there are two important aspects which you have to keep in mind. One, last century challenges, 1900 and 2000. Here they have just mentioned those things, headings. After that, you have got new millennium challenges, first decade, second decade. Here too, they have just mentioned the things. They have dealt the things with respect to third decade in detail. This is the most important aspect. Last century, events which adversely impacted the global economy. First, they have mentioned is two world wars. World War was landmark in the history of the world. World War changed the power equations. There was emergence of USA. There was decolonization. Most of the Asian and African countries got independence after the Second World War, the power equations changed, and also, as mentioned in the survey, after pandemic, the whole equation with respect to power is changing. There is a strong emergence of China. As you are aware, because of World War, millions of people died, not only with respect to military, also from the civilian point of view. Then the second was Spanish flu. So the Spanish flu, don't think that it happened in Spain. No, it was not. In fact, it happened in USA. After that, it spread to France, Germany, and UK. Later on, it infected nearly one third of the global population. There were four successive waves and also 50 million deaths. Here you can see how the soldiers are waiting for treatment. Then next mentioned is Great Depression of 1929. Here, nearly 15% of the people were unemployed. It all began with the stock market crash in October 1929. It was one of the worst economic slowdowns with respect to USA. More than 5,000 banks gone bankrupt. They were out of business. After that, there were many regional conflicts, Israel and Arab conflict, Indo-China, Indo-Pak conflict. There were many regional conflicts. After that, one of the most important aspects was with respect to oil shock. Most important among them was the oil shock which happened in 1970s. Their oil prices tripled. They tripled because of OPEC cartel. Those days, the impact was very, very severe because we were not having any alternate form of energy. The only form of energy which we were having is through fossil fuels. We were not aware of solar energy, wind energy, or the electronic goods and also the vehicles which we are using. These things were unthinkable at that point of time. Next, we had East Asian crisis. With respect to East Asian crisis, they are said to be the tigers, East Asian tigers. So not only the things with respect to Asia, it also affected many other parts. Here you can see has the currency of Thailand went very, very low. This all originated in Thailand. This mainly happened, it began with the collapse of the Thailand currency. After that, all the East Asian countries, one by one, collapsed. So mainly because of two important things. Number one, their debt to GDP ratio was very high. It was about 200% average on an average. Number two, depreciation of the currency. Since their currency started depreciating, they were not in a position to service their debt. See here you can see how these East Asian tigers who are growing at 10%, they smashed it to minus 10. Many went even minus 15. Next, in the first decade, we had technology burst. What is this technology burst? Some 30 years back, the tech industry was the new happening thing. Tech industry was a new happening thing. So all started investing in tech industry, thinking that it will give more return, especially in startups. But of late, they realized that these stocks were not giving the expected result. So so for that they started selling off. So within a matter of 2 years, there was 90% reduction with respect to the valuation of the stocks. So this is known as tech burst or dot-com bubble Next was global financial crisis. This was mainly because of subprime lending. Coming to the second decade was relatively free. There was incident free. Nothing like major happened in last decade or anything like that. But there was minor incidents like taper tantrum. Taper means tapering, reducing. Tantrum means reaction. So taper tantrum was a panic in US over cessation of quantitative easing program given to control global financial crisis of 2008. It was just a small bubble-like thing, not, not much to be considered. After that, trade tensions between the superpowers, especially US and China. Then some few minor incidents in Europe. One most important aspect with respect to all these things is these incidents which happened before the third millennium were having lot of space to breathe. There was a lot of space here. They were spaced out and they gave time to recover and prepare for the next challenge. But the challenges what we have in the third decade are unprecedented. These kind of challenges we never faced and they are coming back to back. With respect to third decade, I have mentioned six important challenges. All these six are interconnected. One is related to another. So let's get started to the core of the chapter. COVID-19 pandemic was announced as a public health emergency of international concern by World Health Organization in January 30. Afterwards, in March, it was declared pandemic. Pandemic induced contraction was there. So contraction, because of contraction, supply reduced. And also there was global weakening of the growth. So global growth decreased. To induce the growth, there was financial stimulus and ultra accommodative monetary policies. So here most important thing, what went wrong was the stimulus which gave, it did not increase the supply. I repeat. So here the stimulus in fact increased the demand but did not increase the supply. Because of that, there was high inflation, right? So let me explain this. So what is inflation? Inflation is increase in prices. So two things which play most important role is supply and demand. If there is decrease in supply or if there is increase in demand, there will be inflation generally, like layman understanding. So what is the remedy for that? So here, after the pandemic, they went for monetary tightening. Because of monetary tightening, sorry, control, to control the inflation, they went for monetary tightening. So here, because of monetary tightening, capital decreased. Since capital decreased, output decreased, but it did not increase the supply. That is the reason monetary tightening was not effective in controlling the inflation. This is one of the most important aspects which you have to keep in mind. Okay, let me explain this again. There was pandemic. Because of pandemic, output contraction, output decreased, supply decreased. Because of that, growth decreased. To increase the output, there were accommodative monetary policy. There were ultra accommodative monetary policy. Huge amount of money was put into the market. So because of that, inflation happened, right? To control the inflation, monetary tightening was done. Here, one of the most important aspects which you have to keep in mind is this monetary tightening was not effective because inflation was due to output contraction. Monetary tightening once again led to reduction of the output. So what happens in monetary tightening? They suck the capital out of the economy. When you suck out the capital, the output will decrease, right? So when the output will decrease, this is the main reason again for the inflation what we have faced. So that is the reason monetary tightening was not effective. And for many reasons like lag effect, all these things, now somehow inflation has come down, but it has not come to the level of pre-pandemic level, right? Is it clear to you now? Okay. Please let me know if you have got any doubt. Okay. Next was Russia-Ukraine conflict, which broke in February 2022, specifically February 24. You can remember like 10 days after Valentine's Day. And the economy was still recovering. We had Omicron in India, Delta variant in America. The economy was still recovering. At that point of time, Russia-Ukraine conflict happened. This increased the commodity price. What are the reasons for that? Number one, Russia and Ukraine are major suppliers of food grains, especially with respect to wheat and sunflower. Not only that, they do supply fuel. So, with respect to fuel or energy, Russia supplies 6.5 billion barrels, and with respect to natural gas, 17% of the natural gas production. Just imagine 17% of the whole world. Not only that, with respect to food, Russia and Ukraine constitute for 75% of sunflower export and also 29% of wheat export. It is not with respect to production, this is with respect to export, total world export. Also, with respect to fertilizers, Russia accounts for 15% of global nitrogenous fertilizers like urea and also 17% of potash export fertilizers. Because of all these things, there was huge increase in three F's. What are they? Fertilizer, fuel, and also food, right? These were the main reasons for increase in inflation, right? So already, as we discussed, there was high inflation. There was inflation already because of pandemic. Russia-Ukraine war led to the accelerating the existing inflationary pressures to unprecedented level. The inflation what we have was not seen for nearly 50 years. The similar kind of inflation we saw in 1970s because of oil crisis. Because of that, there was monetary tightening. Monetary tightening once again led to decrease in growth. In the initial period, inflation in fact increased for many reasons. Of late, inflation is decreasing, but it has not come down to the pre-pandemic level. But still, inflation are at very high level. Okay, let me explain the effects of monetary policy. Sorry, let me explain the effects of monetary tightening. What happens when there is monetary tightening? So, monetary tightening simply means taking away the money from the economy. sucking the money out of the economy. This is generally done by increasing the policy rate. Say, for example, repo. Repo is the basis on which the whole interest rate with respect to lending rate, everything is calculated. When repo is increased, the rate at which bank and NBFCs get the money also increases. When they are getting at a higher amount, the rate of interest they charge on the loans increases. I repeat, with increase in policy rate, the rate at which the banks get money increases. Because of that, they increase the rate of interest on their loans. When they increase the rate of interest, loan decreases. Number of persons coming for loan decreases. Right? Second one, they also increase the rate of interest on deposit. Since the rate of interest on deposits is increased, all the people start putting more money into the bank, right? So here, this also decreases the money which is in the economy. Clear? Next, another aspect will be with respect to SLR and CRR. Because of these two, when these two are increased, the capital with the banks decreases. This decreases the capacity of the banks to give loans, right? Because of all these things, money in the economy decreases. That is the reason it is known as monetary tightening. So it becomes very, very difficult for one to get money from the market, right? Clear? Any doubt with respect to these things? Rate hike by US Fed drove the capital into the US market, causing the US dollar to appreciate against most currencies and rising the sovereign bond yield. This led to many repercussions, like with respect to current account deficit of all major net exporting countries increased. Their currency depreciated, inflation increased. How did all this happen? So here, let me give a small equation. The yield of bond is inversely proportional to the bond price. Mean to say that when there is increase in bond yield, the price of bond decreases, right? This should be the basis to understand the things. So here, especially when there is increase in bond yield. So I repeat, okay, let me explain this again. The increase in interest in US draw the capital into the US economy. This has to be studied with respect to two important things. One is depreciation of the currency and also inflation, right? People who invest in bonds are generally FPI, foreign portfolio investment, not your FII, foreign institutional investment. These people, they are involved in business. They are long term. These people are involved in bonds and security. Let us take an example. Say, for example, an American investor has invested in the bond market of India. He is getting like 500 rupees. He is getting 500 rupees from the bond market. 500 rupees means hypothetical will take $5, right? Now currency started depreciating. So what will happen? He will be getting once again 500 rupees, but the value of 500 rupees will be equal to $4. If further depreciation happens, Once again, the value of this bond will be 500 rupees, but it will be equivalent to only $3. To avoid this, these people started investing in US market, which is stable, right? That is one reason. The other is with respect to inflation. Say, for example, you have got 10% inflation in the economy. So, if there is 10% inflation, then value of your bond decreases by 10%, right? Is the point clear to you? Right? Okay. If you have got any doubt, please let me know. Right. So along with this, so two major things. Appreciation of dollars means depreciation of most of the currencies, and also increase in sovereign bonds. This led to widening of current account deficit and increasing the inflationary pressures in net importing economies. This word is important. When currency depreciates, that affects negatively on net importing countries. So let me just explain this. As you are aware, balance of payments, here you will be having two things: current account and capital account. In current account, trade account and invisible. With respect to trade, major thing is exports. With respect to capital account, you will be having FDI and also FPI. FPI is the one which flies away when there is like little changes whenever they want, not FDI, right? So here, this is with respect to current account deficit, and the capital flight is with respect to FPI. This is the capital account, this is the current account. Let me explain this to you. Please take this example. Case number one, with respect to net importing countries. What does net importing country mean? A country whose imports are greater than the exports. Say, for example, if the imports are $10, the exports are $9, then we say that it's a net importing because import is more than export. So then there will be $1 deficient. That is said to be current account. So this current account deficit of $1 will be paid by the forex reserve, right? So the case one, we are deficit of $1. This $1 we are paying from the forex reserve, that is equivalent to 100 rupees. Case two, after depreciation, the same amount of the goods and services. Once again, only $1 is deficient. But after depreciation, the value of our currency has decreased. So we'll be paying 150 rupees for the same $1. Because of that, current account deficit increases, mean to say widens. Since we are paying more, this not only widens the current account deficit, it also increases the general price level. This leads to increase in inflation. Clear? The other scenario with respect to net exporting countries, where export is more than import. Think that you are exporting goods worth $5 and importing goods worth $3. So net, you are getting an extra amount of $2. This will increase your forex risk. Go back to the previous case. With respect to net importing countries, the forex decreases, but here the forex will increase. This is one of the reasons why China often used to devaluate its currencies, and it was one of the major reasons for trade war between US and China. Right? Coming back again $2. So after depreciation, the same $2 will be fetching you more. Previously, $2 when $1 was 100 rupees, you used to get 200 rupees. In the second case, when your currency has depreciated, $1 is equal to 150 rupees, you are getting 300 rupees for the same $2. So this is a case of current account surplus. Is it clear to you? So when there is a depreciation in the currency, if US is a net exporting country, it leads to current account surplus. But if it is a net importing country, that leads to widening of current account deficit. Right? Any doubt with respect to those things? Please let me know. Okay, fine. So this is very important once again. Many developing countries, especially South Asia, this may be asked, this is the region which was worst affected. Just remember our neighbors, Sri Lanka, Bangladesh, Pakistan, Afghanistan, all these things, all these countries faced severe economic stress. The reasons are a combination of weaker currency. The reason was the monetary tightening and the things surrounding those things, where capital moved out, their currency depreciated, inflation increased, weaker currencies, higher import prices, the rising cost of living, a strong dollar, making the debt servicing more expensive and proved to be much to handle, right? Because of all these things, there was weak growth. Weak growth, monetary tightening, one of the reason, and also combined with inflation, it gave rise to almost the prospects of stagflation. Stagflation is in fact a puzzle to the whole economy. Stagflation is a situation where you have got high inflation, at the same time you will be having low growth, at the same time you will be having high unemployment. Many economists even thought that stagflation can never happen, and also if it happens, it is very difficult to get out of that. Why? Say for example, here we have in stagflation, so the growth is low. To increase the growth, we have to put more capital. So capital should be pumped into the economy, right? If capital is pumped, the chances are high that the growth will increase. But this is not possible. Why? Because already inflation is very high. If you pump capital, the inflation will go to historic levels, unmanageable. Clear? So here, say for example, the other way around. You want to decrease inflation. Inflation is already high, you want to decrease it. So what you have to be doing? You will be taking the money out of the economy to decrease the inflation. This will lead to further decrease in the growth. Once again, as you are aware, if the growth is less, supply will be definitely low. If supply becomes less, once again it leads to inflation. But though economists thought that it can never happen, it has occurred like many times, especially in 1970s. But it's a rare case. We are in fact like heading to recession, not exactly to stagflation. Right? So please answer this question. Very simple question. In 2022-23, there was interest rate hike by US Fed. Which of the following were the results of interest rate hike by US Fed? Number one, capital flew into the US market. Number two, US dollar appreciated against most currencies. There was a rise in sovereign bond yields. Number four, in US, there was increase in GDP growth. What is your answer? Okay, great. Many of you have answered correct. So among all these things, fourth one is wrong because since there is a rise in interest means there is monetary tightening, means there is less capital, means the growth will decrease, won't increase, right? So the answer is C. The fourth challenge was negative growth in global trade. We speak about globalization. What happened, in fact, is anti globalization. What was the reason for this anti globalization? All these things are in line, and you have to interconnect the dots. Weak growth plus inflation led to the economy towards stagflation, prospects of the globe for stagflation, right? Then afterwards, this compelled the nations to protect their economic sphere. Because of that, cross-border trade decreased. This was the fourth chart, right? All these things I have given in a flow. Please go through this. Next was China. So China has considerable slow growth. What are the main reasons? As you are all aware, one of the main reasons was zero COVID policy. But that was not the only reason. As mentioned in the economic survey, zero COVID policy, contraction in real estate sector of China, low fiscal expansion. All these things are important. Not only zero COVID, because even like till December 2022, there was COVID restrictions. Of late, these restrictions have been pulled out, but we are yet to see what will happen to the growth of China. The third one, loss of education. The sixth one, loss of education and income earning opportunities because of pandemic and also war in Russia and Ukraine. Right? These are the six challenges. Having discussed all these things in brief, now let us discuss these things in detail. Right? Is there any doubt with respect to these things? If you have any doubt, please let me know. Ramesh, with respect to M0 and M3, money multiplier, all these things, we'll discuss in the fourth chapter, monetary management, right? Great that you know all these things. Okay. So one most important aspect with respect to all these things is simultaneous occurrence of several challenges to the growth. And this was unprecedented, never known to the history of mankind. All the six, seven challenges, one after the another, back to back. Like the rest of the world, India too faced this extraordinary set of challenges. But India withstood them better than the most economies. As you might have seen, many of the countries have gone bankrupt. Pakistan, Sri Lanka, Bangladesh, Afghanistan, right? Okay. Russia-Ukraine conflict. In this, the most important thing is it disturbed the restoration of supply chain. Just we thought that everything was over, though there was pandemic with respect to Omicron. We were able to manage that. In fact, we were optimistic that it is possible to carry out economic activity despite pandemic by Omicron. Similarly, Delta variant in Europe and America disturbed the restoration of the supply chains disturbed earlier by lockdowns and limited tariffs, price. There was price rise, especially of crude oil, natural gas, fertilizers, wheat, in fact, basic metals, and also coal. So the reason why coal price increased is since Russia was the major supplier of oil and natural gas to the Europe, and because of many reasons, the import decreased. So all the European countries in the winter they started using more of coal. That was the reason. So this strengthened the inflationary pressures that global economy recovery has triggered, right? And with respect to inflation, advanced economies accounted for most of the global financial expansion. As you are aware, pandemic was severe, very severe in Western countries, in advanced countries. One of the major reasons was high proportion of aged population. Other reasons are there. Major reason was that. So advanced economies accounted for most of the global financial expansion and monetary easing. So what will happen to inflation? Too many, too much money was poured. Because of that, inflation in advanced economy breached the historic height. They never saw this kind of inflation in, in recent past. This rise in commodity prices also led into high inflation in emerging markets, which otherwise were stable. So the major culprit here was advanced economies, right? In the last 1 year, the world faced almost the same disruption as caused by the pandemic in 2 years. This is very, very important. We are aware of the pandemic consequences. This and the Russia-Ukraine conflict had equal effect. In the last 1 year, world faced almost as many disruptions as caused by the pandemic in 1 2 years. So Russia-Ukraine conflict, sharp rise in commodity prices due to Russia-Ukraine conflict, prices yet to reach pre-conflict level. So of late, the prices are decreasing, but they are yet to reach pre-conflict levels. So here, base metal prices are also increasing. Base metal means relatively inexpensive, abundant metals like copper, iron, tungsten, zinc, nickel, aluminum, lead. Like gold and silver, these are not base metals. Okay, please you do attention here. So with respect to the prices, most important thing which you have to keep in mind is, see here, prices were almost normal. Prices started increasing here. So what is the date here? So after pandemic, so it was 20 February, Feb 2020, prices started increasing. But their increase was highest only in February 2022 because of Russia-Ukraine war. Yeah, most importantly, highest increase is with respect to fertilizers because Russia provides 15% of nitrogen fertilizers and 70% of potash. And as I told, coal prices also increased because Western countries, to substitute for the oil and natural gas, which they lost because of the war, they increased the coal use. Here, inflation stays high driven by food and energy. And also, as I said, food, fuel, fertilizer. You can add one more. This is with respect to risk on advanced economies or like to a greater extent, inflation used to be very low. Emerging markets, somehow there used to be little inflation always. But this time, advanced economies are the one which were affected the most. And one more important thing here is majorly net exporting countries were not affected to that extent. Here you can see here Japan was on the lower rank. Here if you take this China was low, Indonesia low because they are net exporting countries. Here one more point which you have to keep in mind is with respect to inflation. See here this is US highest rise in inflation. That is the reason in February US started monetary tightening. Is the point clear to you? This is the reason. There was highest inflation in US. To control that, Fed increased the policy rates. Okay. Monetary tightening. Here you can see here. Please give due attention. Very simple graph. We had corona pandemic like in January, December 19 was the one. So in see here in January, the rates were around 1.5%. After that, because of pandemic, it was decreased to 0.25%. See this one decrease. Monetary easing here. Monetary easing, right? After that, this stayed here for 2 years almost. Very, very important, significant one. Please give your attention. From March, Feb or March 2020 till Feb 2022, the rates were very, very low. At this time, in fact, as you are aware, inflation was increasing. All the central banks thought that this rise in inflation is because of some transition, some supply chain disruptions. So they did not take care of these things. They were alert and they became conscious only after Russia-Ukraine war when inflation shooted up. Now, see here, this was the highest hike in the last 40 years of US history. This was a normal one. After that, you can see within the matter of some 5 to 6 months, they increased the policy rate. Right? Please internalize this one. One of the most important aspect. It is a economic history, not just current affairs. Right? Monetary tightening led by U.S. Federal Reserve. It was started by U.S. Fed and central banks have been hiking policy rates and rolling back liquidity to control inflation synchronously, means all are increasing synchronously. The pace of tightening cycle is rapid as we shown. Fed Reserve's pace of rate hike is the quickest since the inflationary pressures of 1970s, an increase in 425 base points since March 2022, right? So as we already discussed, inflation rate started increasing from February 2021 itself. But central banks initiated monetary tightening only after 1 year, that is in February 2022. Why? In fact, this was one of the biggest mistakes. Here, there are two reasons. Number one is that they thought that it is transitory, it will fade away. Number two, they never expected Russia-Ukraine conflict. Because of that, the prices like went to historic high levels. That is the reason if they would have taken monetary tightening way back in February 2021, we would have not had this condition now. Clear? To be precise, the central bank regarded the initial inflation as transient. After Russia-Ukraine conflict, the prices reached the historic heights, so it became inevitable to tighten the monetary policy. Right? Next question in line is, how effective was the monetary policy in controlling the inflation? How effective was this? The second pertinent question is, When will this monetary tightening campaign end? Number one, to begin with, in the beginning, monetary tightening was not effective in decreasing the inflation, right? In the beginning. The reason given for that is lag effect. The second one, though there is monetary tightening highest for the last 4 decades, they are not able to pull out all the things, pull out the excess capital from the economy. Mean to say that we adopted ultra accommodative policies. Means we have already poured a lot of money into the economy. Even after tightening, for 2 years we have pumped the money. So it needs a lot of time to suck this money out. Next is like when will the monetary tightening campaign end? Dear students, most of the central banks are hawkish. They are not in a they're not in a mood to decrease the tightening. The reason is inflation is very high. But one silver lining is that the rate hike, the pace at which they are increasing has decreased. At the same time, they are also afraid of the growth. IMF has reduced the growth rate. This year for 2022, it was 3.2. For next year, it is predicted to be 2.7, right? So the growth, world growth is expected to reduce. So there is a high chances of recession. Because of that, they may like loosen the monetary tightening campaign. But until and unless inflation is reduced, the monetary tightening will be there, right? Impact of monetary policy action is felt with lag. Inflation rates remain stubbornly high during the early phases of the rate hike cycle, but have begun to decline lately. At the same time, synchronous rate hikes by the central banks have not tightened. This is very important. Often you overlook this. At the same time, the synchronous, all the banks like synchronously they acted. This synchronized rate hike by the central banks have not tightened the fiscal conditions sufficiently enough for the central bank to end their tightening campaign. So they are to a greater extent like not able to control the inflation. But it has come down, right? Okay. Financial condition tighten advanced economies and also emerging economies. So financial condition index is a very important one which has mentioned in the economic survey. According to RBI, interest rate may not be able to capture the overall financial conditions that impact investment, that impact economy. So we have to take into consideration interest rate, bond yields, liquidity conditions, the equity, the parameters with respect to credit, with respect to lending, all these things put together, what we get is financial conditions index. So it summarizes the information. It summarizes the information about the current and future state of economic condition in these current fiscal variables, right? I repeat, FCI summarizes the information about the current and future state of economy contained in this fiscal variable. Why is FCI? Because interest rate cannot determine these things. It's a very huge complex, right? So you can see the financial tightening here happening. Okay. So one more important aspect with respect to monetary tightening is inflation. Because monetary tightening was to decrease the inflation. So you cannot study monetary tightening without combining inflation. So monetary tightening and inflation has to be taken care. They are side by side. You have to take these things parallelly, right? Please give due attention. This is very important. Inflation and monetary tightening led to hardening of the bond yield across economy and resulted in outflow of equity capital. So hardening of the bond yields resulted in outflow of equity capital, foreign portfolio investment, right? From the most of the economies around the world into the traditionally safe haven market of US. Capital flight led to strengthening of the dollar against most currencies. This led to depreciation of other currencies. This led to widening of current account deficit and increasing inflationary pressures in net importing economy. Unlike past, this time capital has flown out of emerging markets and also advanced economy. This is the most important finding. This time not only from emerging economies, but also from advanced economies like Canada, like South Korea. So capital has flown from developing countries also, right? Hardening of bond yield across economies. 10-year bond yield, it's been given here. So here you can see hardening of the bond yield means increase in return for the bonds. As you can see. So here one point which you can like notice is the yield of the bonds in developing countries is very high when compared to the yield in developed countries because these economies are stable, their currencies are stable. Since there is capital flight, since these economies are not that stable, there is high inflation, there is high depreciation of the currencies. They have to give more money, right? Okay. The federal funds rate has raised a cumulative of 425 base points since January 2022, leading to capital flight. It is not with respect to current account, it is capital flight from emerging economies and also advanced economy. This is very important. This may be asked because this is a departure from the trend. So FDI is an investment into the business located in a country, in another country, more stable long-term investment. On the other hand, FPI, portfolio investment, investment made in securities and other financial instruments issued in the other country. So the flight was with respect to FPI. This may be asked, right? So this is very important. This we have seen. See here, as I told you, like nearly 18 billion US dollars have flown out of India. At the same time, developed countries like Canada, South Korea also have experienced this. This never happened before. In fact, at the same time, this time, developing countries like Indonesia, Brazil, they had inflow with respect to FPI equity flow. So please keep these things in mind. These are the countries where the foreign portfolio investment is positive. These are the countries where it is negative, right? Okay. Lowering of growth forecast by IMF. So this is a very important one. Recently, IMF has decreased, down revised the growth forecast. So previously, IMF gave some data. In October, IMF said that what we have forecasted is not correct. In fact, The economy is poised to grow in a slower rate than what we predicted. So please give due attention. This is also very important table. Here overall one thing which you can notice is highest growth is with respect to India, 22, 6.8 and 6.1. And there is only one country which has increased the growth compared to 22 in 23, that is China. For all other countries, there is decrease in growth, right? If you see like the overall world, it is 2.7. This year it is like 2022, it is 3.2. United States, you can see this one. Next year, 1% growth. UK 0.3%, and they have reduced this once again by zero point 0.2, means the growth of UK will be 0.1%, means almost zero growth. Emerging markets, okay, they are better off. Okay, so I hope you can answer this one. IMF in its October 2022 update lowered the growth forecast across the countries for 2022 and 23. Why? So as you are aware, IMF comes up with World Economic Outlook. This has been asked in prelims once already. What are the reasons? Can you guess? Let me know. Please type the answer. I'll just give some 30 seconds. Okay, great, great. So as you are aware, one of the main reasons for all these things is like uncertainty of what will happen. There are high chances that Russia-Ukraine war may turn into third world war. At any time, there may be attacks with nuclear missiles, things like that. We don't know what will happen. And also, here, one important aspect is there is monetary tightening. What is the meaning of monetary tightening? There is capital is sucked out of the economy. Since there is less capital, inevitably growth will reduce. Is this clear to you? The major reason for revising of that. And not only that, recent findings in the second half of 2022 showed that the whole economy will be going in a recession. Let me just pinpoint those things with respect to the findings, the developments in the second half of 2022. From the second half of 2022, slowdown in global output because of rising inflation and monetary tightening. Next, with respect to very significant thing, in second half of 2022, significant decline in yearly growth rates of the global trade, retail sales, and industrial output. Very important, retails, trade, and also industrial production has declined in the second half. Along with that, since August 2022, the Global Purchasing Managers Index PMI composite index has been in contractionary zone. So this purchasing power managers are the people who are heading the teams of all major industries who are involved in purchasing. So based on their opinion, they all purchasing managers opinion, they feel that there will be a contraction in future. And there is also one more important reason. There may be further increase in borrowing cost, means there may be further tightening. If the borrowing cost increase, means the capital available will be decreasing. If the capital available decreases, means the growth will decrease, right? These are the four important reasons. Very important question, right? So here you can see global composite PMI in contractionary zone since August 22. So here, and the next other thing was with respect to like year on retails of industrial production and trade. They're also going very right. Like what will happen if there is further tightening of the monetary policy? What will happen? Please let me know. Please answer this question. What will happen if there is further tightening of the monetary policy? So further tightening may lead to recession and also it may lead to stagflation, right? It may aggravate the fragilities built up in the global financial system over the years. This may trigger the financial contagion, which may lead to one another thing. Say, for example, genetically modified crops. If we use more number of genetically modified crops, there may be unintended consequences which may lead to one another. Say, for example, now to begin with, from the beginning, because of pandemic, there was decrease in output. To increase this output, we pumped a lot of money was pumped. Because of that, inflation increased. To control inflation, we have tightened the monetary policy, but the inflation is coming down, right? So here one is related to another, but there are two important fragilities which are built for a long period of time. So what are those fragilities? The main reason with respect to this thing is public debt and government debt. Dear students, very important here at the global level, public debt and government debt of a country is more than 250% of GDP. GDP, final value of all the goods and services produced in a country, means like if there is a home, the income of that home. Similarly, the income of country is 100 rupees, their debt is 250 rupees. So here, debt servicing becomes very difficult. For this, you have to pay the interest. Say, for example, you are paying 10 rupees now as interest. If your currency decreases, value of your currency depreciates, you have to pay more than 10. If inflation increases, that will be stress on forex reserves, right? These are the two important things, which is a challenge for the whole world. And in fact, East Asia crisis, the major reason for East Asia crisis was the debt. All the countries had more than 200% debt with respect to GDP. When their currency started falling down, they were not able to service their debt. Clear? The non-financial sector debt as percentage of GDP since 2023 increased considerably for most economies but decreased for India. Very, very important. The non-financial sector debt as percentage of GDP has decreased for India, but for other countries it has increased. So this is the year in which there was financial crisis, 2008. So here one important aspect which I would like to highlight with respect to the world, as I told, the global average debt is 250. For India, it is 170. That is one point which you have to keep in mind. Compared to 2008, 2008, The household debt has decreased, and also private non-financial sector debt decreased, but the government debt, even with respect to India, it has increased. This is the most important thing. So, dear students, if we as a country, if our GDP is 100 rupees, if we are earning 100 rupees, the debt what we have is 170 rupees, right? Here you can see for most of the countries there is a huge increase. See here, all the countries they have increased. Only with respect to India, there is a decrease. Please go through this. All the countries. Say for example, China, there is an increase in 150 times, but we have decreased. But with respect to India, the notable factor is government debt has increased. The mainly because of pandemic. Because of pandemic, government borrowed a lot of money and it has spent with respect to overcoming the pandemic. Right? Next, non-financial sector debt as a percentage of GDP since 2008 has decreased for India. Why? Anybody? Right? This is one of the most important and tricky questions. And in fact, our medium-term growth, which we'll be discussing in chapter number 2, is built on this one. Right? Great. Suman has given a correct answer. Okay. Mainly because of countries' banking sector balance sheet cleanup during the last decade, where we were having high non-performing assets, and also corporate sector deleverage exercise during the last decade. It has decreased this debt. This is the most important thing. So, how is this most important? Here, banks and other non-financial institutions are the major financial intermediaries. Our banks are in a better position, as you might have heard. There is major collapse with respect to banks in US as of now in March. Like more than three major banks have collapsed in US. But our banking system is very robust. What are the causes for the slow growth in economic activity in China in 2021-23? So, like most of the students know only one. As I told you, the reasons are this: government's zero COVID policy, real estate sector contraction, and a very low financial expansion. All these things you have to keep in mind. Next, China compounded the weak global growth outlook because China is major producer, major supply. China is in the supply chain of all the major goods and services. Very important, please give due attention. China is in the supply chain of all major goods and services. Say, for example, there is a supply chain. This is the end product. These are 10 supply chains with respect to, say, electronics, with respect to production of mobiles, with respect to production of some cars. One or the other place, China is there. So, when China was locked down, there is a gap. This supply chain cannot be completed, right? Okay. So here you can see I mentioned in the economic survey itself, China's industrial production. You can see that this was like around 8% previously before Corona. Afterward, it dipped and it went up, and once again, it has receded. Once again, it has come down here. Not only with respect to the industrial production, the real estate sector, they are using the term like ghost cities have increased in China. Here you can see the infrastructure. It was going at 10%. Now, after 2001, it has decreased drastically. One important aspect is with respect to core inflation. This inflation excludes fuel and also food. Why is it very important? Because fuel and the food, they constitute nearly 30 to 40% of the consumption basket of developing countries. So any fluctuation or any increase in these prices will have a very, very like tight repercussions for developing countries. Okay. So where this topic ends by saying that Europe and US was saved. How was they saved? First was like strong employment data and sharply lower headline inflation for December 2022 have raised hopes for US economy. That is one thing. And Europe, like warmer winters weather, have neutralized the risk of near-term energy crisis, which was induced by Russia-Ukraine war. The winters in Europe was warmer, so there was less fuel required. Okay. And of late, with respect to the negative things, lately, banks have reported much weaker earnings. See, this was reported in the economic survey like way back in February. This is coming true now. In March, many banks in Europe have gone bankrupt. Banks have reported much weaker earning growth, and technology companies have begun to announce layoffs. Major companies, major technological companies. So one of the reasons they are giving is other than decreasing growth is major one. Other than that, artificial intelligence. So we are not aware of this. Behind the screen, artificial intelligence has made high progress because these technology institution companies they can use more of artificial intelligence. They can replace, right? So yet another latest information for you. This is not given in the economic survey, but it is in news. Collapse of Silicon Valley Bank and Signature Bank were the second and third largest bank failure in the history of United States, smaller only than 2008 collapse of Washington Newton. So, like we don't know what may happen to the economy because major banks in US, two major banks have collapsed. Therefore, on balance, downside risk for global economy dominates. Right? Is it clear to you? This completes this topic. Right? Next topic is with respect to macroeconomic growth challenges in Indian economy. Here, majorly, we will be discussing the repercussions of global challenges. Right? If you have got any doubt, please let me know. So this we will discuss in our next class. If you have got any doubt, please let me know. Okay. Okay. Dear students, this is Raghu signing up for now. Until we meet again, keep reading, enjoy your preparation. Take care.